Another day, another sell-off for the stock markets, but are we finally getting to some level of exhaustion? Perhaps as event risk starts to beckon and loom ahead. This is Macro Money. I'm Ilya Spivak, head of global macro here at Tasty Live. And we're going to have a look here at the incoming macro event risk now in front of markets in the next 24 hours and consider what may be the next step here. And if, in fact, these markets are finally starting to get a little bit more of a reason, at least, to pause and think. And of course, before we get into the meat here, so that we're not talking out of turn, let's quickly consider where we find ourselves. This is the S&P 500. Obviously, we're looking at a dramatic sell-off now that has erased just about half of the rally from those August lows. The last time we had any kind of a reasonable sized sell-off here was back from about the mid-year through the beginning of August last year. This then gave us this rally, and we're rapidly erasing it here since late February. The sell-off follows first and foremost this U.S. CPI or PMI rather data, the Purchasing Manager report from S&P Global. They tell us as of February the 21st, and if you want to go and play the home game, just go ahead and take a look at where that date is on any given asset chart that you like. Almost all of them will have an inflection point right there if you're looking at anything with any sort of market-wide significance and decent liquidity. And so the message clearly starts to shift right there, and you can see why. As ever, this data operates around a center line at 50. That's neither growth nor contraction in the given sectors that you're looking at. Above 50 is growth. Below 50, the sector activity is shrinking, and the further you go above 50, the faster the expansion. The further you go below 50, the faster the contraction. So what we see here is a little bit of a pickup in manufacturing, perhaps for all the wrong reasons. The reporting suggests it is probably the temporary influence of front-running any potential tariffs that could be coming and have been on again, off again for weeks. The flip side of that uncertainty has been a rapid deceleration in the service sector. That, of course, a much larger part of the economy than manufacturing. And so we can see the composite index that takes in both has been closely tracking the services side. And when that gave way in January and then showed further strain in February, this rapid move toward almost no growth at all, almost approaching neutral here on the services side, that clearly took down the aggregate. And now we're looking at a very dramatic slowdown in U.S. economic activity growth. Of course, this is just one data point, but if we look at a model that takes in the ongoing flow of U.S. economic data, this is the Atlanta Fed's GDPNow tracker, we can see that their running estimate for first quarter GDP growth has absolutely fallen off a cliff from this sort of mid-February normal. And again, you can see that this starts to happen in late February. Once you sort of establish this sort of initial normalization to right around 2.1, maybe 2.2%, you've now utterly collapsed, expecting a decline of between 2 and 3%. Now, of course, we're quite a ways away from getting this data actually published, so this is going to shift around still. But what this tells us, never mind the actual level of growth. What this tells us is the direction that the data fed into this model has been going. The fact that the model has so dramatically collapsed tells you that the economic inputs going into it have been abysmal. And of course, that validates what the PMIs showed us early on. Not surprisingly, the result has been a dramatic dovish shift in Fed policy expectations. You can see it clear as day right here. In the green is the outlook for this year as priced into Fed funds futures in the yellow. Next year, in the orange, is the sum of the two. And you can see the implied Fed policy path from late February through to now has seen a dramatic dovish revision. Just a month ago, the markets were looking for about 50 basis points in cumulative easing. Now, the market is priced for 121 basis points in cuts through the end of next year, of which 3 are on the menu for this year. You can see 72 basis points here, almost the full 75. And for next year, we're only a basis point shy, 49 basis points on the menu. A full 2 cuts would be 50. So we're looking at now 5 cuts on the board, most of them this year, slightly so, a 3-2 spread. So the market is looking for urgent policy support and is starting to reckon that more of it ought to come than even just a month ago looked reasonable. Indeed, the Fed's own forecast back in December called for only 100 basis points. So the markets have now, having been a little bit more hawkish than the Fed, flipped to the other side of the ledger. And they're now screaming at the central bank that they need policy support. If we look at the timing here, we can see that whereas in September was the last time that the Fed was very dovish, and then we saw that over the course of the coming months, the relatively warm economy toward the end of last year in the fourth quarter saw a revision in expectations. We then started to see this kind of clustering in this area across November, December, and even the January FOMC meeting. Well, if we look at the current curve ahead of what's on the menu here for the FOMC announcement next week, we are now the most dovish in policy expectations that we've seen since September. So the market's clearly here starting to drift in a more stimulus-oriented direction. We can see current rates at 4.38, seen, that's of course the median between the Fed's target of 4.25 to 4.5 range. As we see this evolve, we see the Fed seen holding in March, holding in April. We start to lean in the direction of easing by June, and in July, that easing kicks off. So the first rate cut in this year's cycle seen somewhere around mid-year. The response from markets, of course, has been unmistakable. We can see that what the growth scare has done is pulled down yields, both the 10 and the 2-year here. The yield curve has narrowly widened just a bit, mostly because more and more of the easing is heading into both sides of the spectrum, and the immediacy of what the market is calling for, this more pronounced build out at the outlook for this year. That's given us a little bit of a steeper curve as the front end starts to price in stimulus that comes sooner. We've also, of course, seen a dramatic decline in the U.S. dollar in the green here as yield differentials shift against it with this pricing of more stimulus. And inflation expectations, as they are priced into the bond market, have started to tilt down a bit. That, of course, would be consistent with some sort of an economic downturn. And indeed, it is inflation that we are concerned with. Over the next 24 hours, we're going to get an update to CPI figures. Expectation here that a little bit of a cooling is on the menu. Headline number expected to come in from 3% to 2.9%. That would be in line with December's reading, so essentially erasing the uptick that we saw from 2.9 to 3 in January. The same thing seen for the core, coming in from 3.3 to 3.2% year on year. Again, reversing January's uptick and coming back to where we were in December. Now, if we look at the Cleveland Fed's nowcast modeling of CPI, we can see that realized results most recently here ran a little bit hotter than expected. But if we look at what we're anticipating now for the coming month, it looks like not much of a change in the core, but a little bit softer in the headline. So the modeling here seems to agree that we are in fact heading toward some amount of disinflation. So at least directionally, seems like we might actually move as expectations are suggesting. And although we overshot expectations in the last month, why we overshot them is perhaps telling. If we look at the makeup of the data, that tells an interesting story, and we'll get there in just a moment. But before we do, the overall tenor of U.S. economic data against the backdrop here is, of course, pointing to deterioration. Not surprising. In fact, this was one of the early indicators that we cited here on Macro Money ahead of those PMI numbers, saying U.S. economic data is starting to tilt toward disappointment. That's what we need to be looking for. And of course, when those disappointments started to roll out with the PMI data is when we saw the markets roll over. This is why this indicator is so very useful. We can see here that already from the middle of November, U.S. economic data starts to deteriorate relative to forecasts. This is an index from Citigroup that measures not the absolute outcomes, but where those outcomes register compared with median economist forecasts. And if, in fact, a move is particularly market moving, that increases its weight in the indexing to make this indicator. So you get a real good sense not only for the dynamics of the data, but also for how responsive the markets are to those dynamics. So you start to see this deterioration. And of course, most recently, what you get is a move through this zero line, implying that U.S. economic data, any given piece of U.S. economic data, now tends to disappoint, or at least has a bias toward disappointment relative to expectations. And it's simple to conclude why. If the economy is structurally weaker than analysts' models heretofore anticipated, those models are going to need some of their assumptions revised, some of their settings retuned. And since economic data tends to operate on about a month cycle for most of the data, some of it is weekly, like jobless claims. Some of it is quarterly, like the numbers on GDP. But most data runs on a monthly cycle. And it typically takes a month or two for analysts to start to take enough inputs to adjust the modeling. And until then, you still have this disconnect between reality and what that modeling gives you as forecasts ahead of economic releases. So what you're seeing here is underperformance relative to expectations that then sets the stage for more underperformance relative to expectations until analysts revise these models. And of course, we'll see that in this index too, as scope for downside surprises fades. But for now, the path of least resistance seems to be to still lower CPI numbers than is already anticipated. Now, If you were to get that, what the markets might conclude is that the Fed has more room to ease policy, and that would help to validate some of this more dovish repositioning that we've seen recently. But for its part, the Fed has been interestingly resistant. In fact, we just saw on Friday that in a speech that we're supposed to update everyone on policy expectations, Fed Chair Powell struck a much less dovish tone than all of this fire and fury in the markets might imply, saying that the central bank does not need to be in a hurry to adjust interest rates, and that while uncertainty around the Trump administration policies and their economic effects remains high, the U.S. economy is in a good place nevertheless, and that the Fed is well positioned to wait for greater clarity, because the net effect of trade, immigration, and fiscal and regulation policy is still unknown, and there's a need to get a clearer read on that before the Fed acts. Helpfully, according to Powell, the Fed has room to sit and wait. There isn't urgency, apparently, in his mind. And so the question then becomes, well, you get a soft CPI number, but the Fed doesn't want to act. What does that mean? Well, to some extent, the Fed might be forgiven for being, as it typically is, reactive. If we look at the annualized pace of inflation change as a gauge of recent dynamics, looking at the headline, that's the blue and the red bars here, you can see the 3-month annualized rate is accelerating. The 6-month annualized rate is accelerating. If we look at the core, which is what the Fed frankly cares the most about, that's the bit that excludes volatile food and energy prices, over which the Fed really doesn't have much agency. They're set in global markets. And in any case, as we saw from these breakdowns here, almost everything that's left of inflation sits within core services. If, in fact, the Fed were to get what it needs, it would need the core to move. We can see here the 3-month rate in the core starting to tick up again. That's the yellow bars here, after a little bit of a cool down in December. And of course, the 6-month rate has been marching higher since essentially November. Higher in November than October, higher again in December, higher again in January. So the dynamics here are understandably worrying for the Fed, that wants to still get to that 2% inflation target, doesn't want to cut too soon. In fact, despite economic sluggishness, what we just got from the latest numbers from the Institute of Supply Management's version of the PMIs is another strong uptick on the pricing side. So inflation against this backdrop, perhaps not quite as vanquished as the Fed would need in order to really push for more stimulus in the near term. So you get this soft CPI number, and the Fed is perhaps reasonably resistant, perhaps resistant in a way that's understandable. What the delta is between reasonable and understandable, we'll have to wait and see. But if the market reckons that the Fed isn't going to jump the gun here and immediately readjust, even on a soft CPI number, well, then the speculative outlet may well come for these 2026 policy expectations. And so you would expect then that the market would say, right, the Fed is going to drag its feet. That means it's going to have to do more later, because it'll be playing catch up to an economic downturn that is already starting to get away from them. That would mean that more rate cuts need to happen in 2026. We, of course, saw this movie last year. You can see here the market starts to really build out 2025 rate cut expectations when the Fed is dragging its feet on cutting into what looks like an economic downturn at the end of the second quarter last year. Not surprisingly, again, let's go back to this economic surprise index. Here's that turn right here. So when U.S. economic data starts to do this from mid-April going into July and August, you get this from mid-April going into July and August. And then once the economy starts to improve, late August into the Fed's September announcement and into this more recent downturn in November, you can see policy expectations start to get less dovish. And in fact, this is the Fed's peak for its dovish stance in September. And of course, by then, you're already seeing improvement here. The bottom's here late August. So when the market gets an ultra dovish Fed, they go the other way and say, no, that's way too dovish. And so by November, we're already here. If you get a soft CPI number and the Fed is resistant, then you're back at the start of a process that's similar. And this would tell you that the yellow area here has room to build out further and for this wedge to open wider as the market anticipates more Fed policy support downwind. In practice, that speaks to probably a weaker dollar, probably lower yields. The real question, of course, is what does this mean for stock markets? Whether this now here ends up as a concern, or if the markets are prepared to take some heart in more stimulus expectations. And it really seems to come down to the internals. Now, we just mentioned we had that upswing in inflation in January, but if we looked under the surface, it came not from the place where you'd want to see it. It came from the good side of the ledger, going from a net negative contribution to inflation to a fractionally positive one. It came from less of a negative input from the energy side. But the part where most of the growth lives, as we can clearly see from growth here being powered by services, even as manufacturing gets anemic, as we can see where all of the pricing impetus is in CPI. It's all in services. And what we saw in January was that despite an uptick at the headline and the core, the place where growth lives weakened. So if we see something similar in this data where the core services component of CPI continues to come undone, it wouldn't be shocking for the markets to say, well, the Fed isn't coming to rescue us, risk off. But to the extent that the market has already been pricing in this story, what a soft CPI number may do is perhaps tell the markets, well, we already know there's a problem, and the soft CPI number maybe gives the Fed an outlet to promise us a bit more by way of support next week. So maybe we get a bounce into here, somewhere within the vicinity of the 5,700 level. But to the extent that the Fed believes what it is saying, an FOMC announcement may well disappoint such hopes. And so any bounce from here looks more like an opportunity to sell at better levels into a downtrend that's building rather than a true buying opportunity. And that is macro money for today. As ever, we are here Monday through Thursday, right after overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I am likewise on with Chris for Futures Power Hour Mondays and Fridays, on in just 30 minutes time from now, as I am every Tuesday with Victor Jones for The Price of Truth. Definitely come and join for that. It'll be a spirited discussion, no doubt. Back with Victor and Tom for First Call on Sundays, writing for the news and insights portion of tastylive.com, and commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. Thanks very much for joining. If you're watching on YouTube, like and subscribe. Macro Money's back tomorrow. Happy trading.